Hello, I am Joseph Woodman and I am your mortgage millennial. Today I want to talk about student debt and retirement. I know for a lot of us in our 20s and 30s, it seems like retirement's a long way off and we don't think about it very much. But a little bit of thinking about it in your 20s and 30s means that you don't have to think about it nearly as much in your 40s and 50s. So I think it's really, really important that we start to get on top of this. Now, there are basically three types of student loans. There are federal subsidized loans, there are federal unsubsidized loans, and there are private student loans. Now, federal subsidized loans are actually pretty great. And if you have these loans, you might be sitting at about a 4% interest rate. And really, it's okay to just kind of sit tight and pay what they ask you to pay until either the debt is paid off or you hit some kind of debt forgiveness timeline or threshold. And even if you had the cash to just write a check and pay those off right now, that might not even be the best way to use your cash. I mean, that's just how nice these federal subsidized student loans are. Now, unsubsidized federal student loans, which are very, very common, and private student loans. Now, those are actually a really big deal. Now, when you start to get up over 5% interest, which is very common in federal unsubsidized loans and in student loans, these interest rates really start to become a problem. Now, when they hit around 7%, which is a pretty typical interest rate for a federal student loan, they become a major financial anchor in your life. Now, those rates could be a lot worse, especially if you are in a private student loan or if you have private student loans. Now, the problem is that when you have student loans with these kinds of interest rates, you are accruing interest at a rate that makes it really difficult to keep up with those monthly payments, to stay ahead of that interest. But I actually don't think that's the worst part by itself. The worst part, to me, is that it just doesn't make a lot of sense to save towards retirement when you have those kinds of student loans. Now, the reason why is because you're going to be losing money through interest, most likely at a faster rate than you're going to be able to make money in like a mutual fund or a typical retirement account. And that just drives me bonkers. It actually grieves me to think that you can be a responsible young person, way ahead of maybe where your parents were as far as financial acumen and awareness. You can be ahead of the game thinking about retirement in your 20s or in your 30s and trying to make wise decisions to make your life wonderful in your golden years. You can be like that and still finish behind all those average people that really don't start to think about their retirement until their 50s. Or even later. Now, the good news is that if you have a home, especially in an appreciating market like we have here in Northern Colorado, you can use the equity in your home to free yourself from the burden of student debt. Now, this has kind of always been an option in the past, but Fannie Mae, who, if you're not familiar with what Fannie Mae is, basically Fannie Mae makes all the rules that we have to play by in the mortgage business. But Fannie Mae just made it easier to do this. Now, before I get into how they made it easier, let me talk about there's basically two types of refinances. There are rate and term refinances, which basically people use a rate and term refinance to lower their monthly payment or to change some kind of term in their loan. And then there are cash out refinances. And a cash out refinance is exactly what it sounds like. You basically trade the equity in your home for cash that you get to use in really whatever way you like. So you could pay off debt, you could pay off credit card debt, you could buy a boat, you could build an addition onto your house. But there is a hitch to a cash out refi. Cash out refis, typically you end up with higher interest rates than in a rate and term refinance. Now, if you're trying to build wealth over time, which is basically what retirement is, building towards retirement, it's building wealth over time, every tiny fraction of a percent really matters. Now, So what Fannie Mae has done is changed the rules just a little bit so that if you are using your cash out refi to pay off your student debt, then we kind of get to pretend it's like a regular old rate and term refinance, which the difference in the interest rates between those two types of refinances can save you thousands of dollars. And more importantly, they can create a pathway so that you can change this crippling, debilitating retirement sandbagging 7+% interest rate student loans into kind of modest, manageable 4 or 5% mortgage debt. Now, using the equity in your home to get out from underneath student debt, it's not going to be for everyone, but it might just be your best option for dealing with the monster that is student debt. And if you're curious, you just reach out to me. You reach out to me on Facebook, send me a message, and I'd love to buy you a cup of coffee and talk about your specific situation. Now, if you don't own a home and you'd like to know what you need to do to get to where you can buy a home, I would also love to meet with you. So just reach out. I'm super friendly. I'll always make time for you. Yeah, again, my name is Joseph Woodman, and I am your mortgage millennial. Have a wonderful day.